Hey everyone, welcome back to Corporate Decoder, the place where we'll decode the secrets hidden in plain sight within corporate filings. Today we're diving headfirst into Soho houses. Latest quarterly report, a document that's more like a financial soap opera than a dry business report. Get ready because things are about to get interesting. Alright, so let's get straight to the numbers. This filing covers up to September 2025 and it shows us where Soho House stands financially right now. First up, total assets. As of September 2025, they stood at a massive $2.68 billion. That's a huge number and it's up from just over $2.44 billion at the end of 2024. So the company is definitely growing its assets. What makes up this pile of assets though? Well, a big chunk of it is property and equipment sitting at over $724 million. This is up significantly from around $598 million a year ago. It tells us they are investing heavily in physical locations. Leased assets are also massive at close to $1.17 billion, showing the heavy reliance on leases for their spaces. Now let's flip over to the liability side. Accounts payable went up to $90 million from $75 million. Accrued liabilities also jumped to over $132 million from $98 million. This just means they owe more money to their suppliers, employees, and for other short-term expenses compared to the previous year. Overall total liabilities are sitting at over $3 billion. That is quite a bit more than their total assets when you factor in their shareholder deficit. And speaking of deficits, we see an accumulated deficit of over $1.5 billion. This means that cumulatively since the company started, it has lost more money than it has made. This is common for growth companies, but it's a significant number to keep an eye on. Let's look at profitability. For the last 3 months of September 2025, the company reported a net loss of over $17 million. That follows a net gain of just $175,000 in the same period last year. Looking at the longer 9-month period of 2025, they actually made a profit of over $14 million. This is a huge turnaround from a loss of over $71 million for the same 9-month period in the previous year. So while the most recent quarter was a loss, the longer trend is looking much better. Total revenues for that last 3-month period reached over $370 million. That's a solid increase of 11% compared to the same period last year. The 9-month revenue figure hit over $983 million, also up about 9%. So revenue is growing nicely. Membership revenues, that's where a lot of the recurring income comes from. It hit over $122 million for the last 3 months, up 14%. And for the 9 months, it was over $354 million, up 15%. This shows strong growth in their core membership base and likely due to price increases which they mentioned. They increased prices for existing members by about 8 to 9% and for new members by about 10 to 12%. In-house revenues, that's all the money from food, drinks and hotel stays within their locations, were over $126 million for the quarter, up 5%. And for the 9-month period, it was over $371 million, up 4%. This is steady growth, but not as explosive as membership. Other revenues, which include things like their Soho home retail brand and hotel management fees, brought in over $121 million for the quarter, up 16%, and for the 9-month period, it was over $258 million, up 12%. This segment is growing well and includes contributions from their Scorpio's beach clubs. Now for the costs, in-house operating expenses went up 8% for the quarter to over $172 million. This is happening even as revenue is growing, so their profit margins on these services might be a bit squeezed. For the 9-month period, it's up 7%. General and administrative expenses also increased significantly, up 22% for the quarter. This is a big jump and they attribute it to new house openings and expanding partnerships. Let's look at adjusted EBITDA, a measure they use to gauge profitability before certain items. For the last 3 months, it's up 11% to over $53 million. For the 9-month period, it's up a massive 47% to over $146 million. This is a very positive trend showing improved operational profitability. So what is driving this? The number of Soho House members is up to over 213,000. That's a good increase from last year. They also highlight the opening of new houses and new locations for their other brands like Soho Works. Now for the elephant in the room, the merger, they announced a deal in August 2025 to go private with an investor group led by Ukaipa Companies and Ron Burkle. This deal values the company at $9 per S-share in cash. This means shareholders who don't roll over their shares will get cash. It is a big strategic shift. They mention the deal is subject to shareholder approval, and there are a lot of conditions. They even mentioned potential delays due to sex reviews, leading to possible delays beyond this year. This merger is a huge talking point, and their report highlights the risks. If the deal falls apart, it could really hurt the company and its stock price. They have a lot of deal-related costs too, and it's distracting management. They specifically mention that investor confidence and business relationships could be affected by the uncertainty. The report also details risks if the deal doesn't go through. They might have to pay a termination fee of $20 million to certain investors, which would be a significant hit. A key risk they point out is foreign exchange. Since they operate globally in the UK and Europe, they have exposure to fluctuations in the British pound and the euro. They estimate that a 10% change in the dollar against the pound could impact revenue by millions of dollars, which is a significant risk. Interestingly, they received a big payout of $23 million in business interruption insurance related to COVID-19. This cash injection really boosted their financials for the 9-month period, helping to turn a big loss into a profit. They're also dealing with complex accounting for joint ventures and variable interest entities, a sign of their sprawling global operations. They have to consolidate these entities because they are the primary beneficiary, meaning they control the significant activities of these ventures. So what's the verdict? Soho House is growing its revenue and membership base, and its profitability is improving, which is great. The merger with Yucaipa is a massive strategic decision that could fundamentally change the company by taking it private. There are significant risks involved, especially if the deal fails, but if it goes through, it could provide stability and a new direction. Financially, they're showing better operational performance as seen in the adjusted EBITDA growth, but the accumulated deficit is still a big number. Their reliance on leases and their global currency exposure are also key risks to watch. It will be fascinating to see how the merger plays out and if it truly unlocks shareholder value, or if the risks outweigh the rewards. Alright, that's our breakdown of Soho House's latest filing. What's your take on these numbers and what they signal for the company's future? Do you think the merger is a good move or a risky gamble? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more discussions. Thanks for watching, see you next time.